Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this video, the 2025 tax changes, everything you need to know for 2025. We're going to be going from everything from RRSPs to TFSAs, prescribed rate loans. I'm even including some tax deductions that you probably weren't aware of. So stay tuned. Hope you enjoyed today's video. And as always, put your comments below. I love reading your comments. It gives me some insights as to what you like and what kind of videos you'd like for me to make in the future. Let's get 2025 off to a good start with a great video. Let's begin. Okay, the Canada Pension Plan is a great place to start. This happens to be a subject material for most of you. As it relates to my channel, about 85% of you are over age 50, so I think CPP is something that you care about. So let's review Canada Pension Plan real quick. YMPE, that's the year's maximum pensionable earnings. That's the name of the amount of money that the government is using to tax you for your Canada Pension Plan. So on your employment earnings, if you are working for someone, the government is going to take your first $71,300, and that's the total amount of money that they're going to use to tax you towards your Canada Pension Plan contributions. Now, there is a basic exemption of $3,500. So what does that mean? So your first $3,500 doesn't go towards the Canada Pension Plan. It's only after $35,001 up to $71,300 is where they use that amount of money to tax you at 5.95%. And if you take that, then the maximum contribution that you can make to your Canada Pension Plan is $4,034. Now, if you are self-employed, you have to pay both the employer and the employee. So that's hard for a lot of self-employed people, but that's $8,068. Now, recently they introduced something new, that's Canada Pension Plan 2. This is an enhancement of the Canada Pension Plan. And this is for anybody that makes more than the $71,300. Is actually YAMPE, so that's the year's additional maximum pensionable earnings. So anything above or up to $81,200, you're also contributing to your Canada Pension Plan. And let's look at that. Any amount between the $71,300 up to $81,200 is subject to the CPP 2, and that's 4%. Maximum contribution is going to be $396, and again, if you're self-employed, you're paying both of those premiums, so you're paying both the employee and the employer. So a little bit harder for self-employed people. RRSPs, this is by far the biggest retirement savings tool for Canadians. It can be very useful, and it can be a real pain in the behind for people who have made a lot of money or went in a different direction as you're going through retirement. You thought, let's buy some retirement assets like rental properties, and you got all this income coming in, and you said, gee whiz, that RRSP contribution is a real pain. So that's why you need to get a financial plan done to help you with your withdrawals. But let's dig into what does RRSPs mean. 18% of your earned income can go towards your RRSP. And that's 18% of your previous year's income. $32,490 is the maximum that you can put in each year based off of the previous year. And if you have any unused contribution room, well, what does that mean? If you didn't contribute some of your money to your RRSP, let's say you're allowed to do $32,400, whatever you don't contribute, you can be saved to go into the next year or future years when you want to use that towards a deduction. So if you're not contributing the maximum, don't worry. In years where you make more money, you can go ahead and use your unused contribution room. Now, for those of you who are contributing to a defined benefit pension plan, whatever your employer is contributing to that pension plan must be subtracted from what you're permitted to deposit to your RRSP. So that's called a pension adjustment. So let's say your pension adjustment was $10,000 and you could have put in $32,490. That means you can only put in $22,490 into your RRSP. So you see that the pension adjustment reduces the amount of money you can go into an RRSP. So very important you keep that in mind so you don't over contribute to your RRSP. Oh, and by the way, March 1st, if anybody is interested, is the 2025 deadline to make your RRSP contributions for the previous year. Tax-free savings account, nothing's changed here. $7,000 annual contribution limit, same as last year. Now, last year, the lifetime limit was $95,000. We're adding now another $7,000, so you've got $102,000 lifetime limit. let me take a moment to explain lifetime limit, because I posted a video about tax-free savings account and some of you got a little confused about it. So let's explain that. A lifetime limit means if you were 18 years of age in 2009, you have till today the lifetime limit. So going back to 2019, you had to be 18 to contribute to a TFSA. So if you're 18 in 2009, all the way through to 2025, you can contribute a maximum of $102,000. Now, this is where you sort of got a disconnection in this. I posted this video here, $1 million TFSA portfolio. You guys went crazy with this video with your comments. You were saying, how is it possible that you can get $1 million in a TFSA when the maximum contribution or lifetime contribution was only $95,000? That was last year. And so let me take a minute just to explain that. You can contribute, if you've never contributed before to your TFSA, a maximum of $102,000 into your TFSA in 2025, okay? But let's say you have been contributing your TFSA and you grew it to $250,000. So you know what it means. You put in $95,000, you put it on some technology stocks, your money's gone up crazy, and now you've got $250,000 in your TFSA, and you did a withdrawal last year in 2024, the whole lot, all of it went out. Well, how much money can you contribute in 2025? Well, you can put back the $250,000 plus the $7,000 that you are allowed to contribute in 2025. Now, how do you get to $1 million? Well, if you're growing that money over a period of your lifetime, and let's say you didn't put in any contributions over that period of time and you had zeros in terms of contributions, and then you did a downsizing event. So this is what this video was all about. When you do your downsize and you've got a big non-registered account, because you've got $1 million, let's say, from your downsizing of your home, you can put whatever you were permitted to put into your TFSA, you can fill that up right away. So you see later on in life, if you didn't do your contributions, because a lot of you don't make contributions to your TFSA in retirement, and you really should. If you've got extra money, keep filling up your TFSA every single year. That's how you get to well over $1 million in a TFSA. Okay, let's move on to the next one. Your first home savings account. By the way, how are we doing? Got any comments? Throw it below, and remember to like and share this video with anybody that needs to see this. This FHSA account was really created a couple years ago, and very good savings plan for people who want to get into first time in a home. What's unique about this, which is different from the other savings plans for homes, is that the contributions are tax deductible. You can put $8,000 in every year up to $40,000, and you get to tax deduct it from your own income. If you open an account in 2024 but didn't make any contributions, you can put your $16,000 in 2025. Now, for those parents who say, I'll just give some money to my kids and they'll make the deposits, understand, or like the government wants to try to track where this money is coming from. So be very careful about what you're doing with your money. Even in joint savings accounts, it's, you're trying to say this money is my money and the government is trying to figure out whose money is it really. You just want to be careful that you're not bending any rules here and getting into any trouble. Okay, the CRA prescribed rate loans. This is important for the people who are on this channel. Why? Because you're all thinking about how to save taxes. How do you get money out of Canada Revenue's hands and keep it more in your pocket? And so what I'm finding is that people who have this discrepancy between tax rates between spouses, this works really well. Now, it didn't really work well over the last few years when rates were really high. Prescribed rate loan rates were 6-7%. Rates are starting to come down, and this is starting to make sense now. So let's share with you a little bit how this works. For 2025, the rate is 4%. So what does that mean? You can loan money to your kids or to your spouse at 4%. They have to pay the interest on that loan before the next year, before January 30th the following year. They have to make that payment to you. If you don't, then that's not a prescribed rate loan, and you're going to have to pay the income tax on the money that you gave them. So let's say you give your spouse some money, $100,000, and they invest it in the stock market. and let's say they didn't pay their interest to you by January 30th of the following year, then you're going to have to pay the interest on that loan, or you're going to have to pay what they earned in that investment. So that's not what you're trying to do. You're at a higher tax bracket. You're going to give money to your spouse who's in a much lower tax bracket. They're going to invest the money. They're going to pay the interest, or they're going to pay the interest to you, and they're going to report the income that they get, whatever their income is off of that $100,000 investment. They're going to report that on that tax return. So their tax return or their tax rate is going to be lower than yours, and that's how you can legally avoid paying taxes at your rate, because you don't want to pay that tax. And that's this attribution rule. By just simply giving the money doesn't work. If you do a loan, it's going to be much better for you. Now, 4% is pretty attractive given the fact that we'll just say the stock market or the indices have returned some pretty ferocious returns. I like to say ferocious because it's been on fire in 2025 or 2024. So this could be something that could help reduce the tax bill for people who are in this big discrepancy of tax rates. Okay, now, just a word of warning. If the person is going to take the money and put it into something that is going to be tax deferred, or a return of capital, something where they're not really getting a lot of income tax or zero income tax because it's a return of capital, then you shouldn't be doing this. It should only be done if they're investing in something that's going to produce a high tax rate. Lifetime capital gains exemption, this by far is something that if you're in business, you should know about this. What I see all the time when I look at corporate structure is that many business owners have got mixed assets that make lifetime capital gains exemption very difficult for you to claim when you've got your corporation. So you've got an operating company, a holding company, and in those you've got maybe some mixed assets like rental properties. That has nothing to do with your business. And that can create a problem for you to exercise your lifetime capital gains exemption. So what is it? Right now it's $1,250,000. That's what the government is trying to pass through for this tax year. It allows small business owners to really lower the taxable burden of selling their shares when they're, let's say, wrapping up their company or selling their shares. They would have a capital gains that they have to pay. And so if it's possible, because there is some eligibility requirements in using your lifetime capital gains exemption, that you could write off 1.2 million, the write-off people, right? You could write off 1.25 million. That would be very useful. Now, something else that's really cool is that if you include your spouse and bring your kids on board in the corporations, they all come with $1,250,000 of lifetime capital gains exemption. So it's a great way to be able to multiply the amount of money that your company could avoid legally paying tax. Medical exemption threshold. This is the part in the video where I'm talking about some deductions that you're probably not aware of. For those of you who are paying medical expenses out of pocket, you can deduct 3% of your net income, or $2,834, whichever is lower. And which is really interesting is, so I looked up what are the eligible expenses. You can just type this into a Google and it'll tell you, just click on the button and it'll tell you. But I've shared with you some really interesting ones that I was really surprised, like ambulance, bathroom aids, crutches, hearing aids. If you have celiac disease and you need gluten-free foods, that's part of that. If you need a scooter to help you get around, cancer treatment. Any of you claiming the disability tax credit, and your doctor's charging you for that? Well, that can also be submitted as one of your deductions. Dental services, things like dentures, can be also claimed. Ergonomic work chair. Let's say you've got a prescription from a doctor that you got a bad back, chronic kind of problem. You could purchase an ergonomic work chair for your home office and say it's a deduction. Prescribed medicines and even medical travel. So the government will actually give you, I know there's some grants out there that you can have, but especially for people that work in northern provinces. But you also can claim medical travel if you have a distance to travel for that care of greater than 40 kilometers or 80 kilometers. There's deductions including having an assistant travel with you, so their expenses as well to help you while you're doing the medical, what kind of procedure you're doing. So all those things can be included. That's not all of them. The page is just very exhaustive. I just put some that I thought you, my audience, would probably are going through some of these things, and you say, you know what, let's include that in the tax return. Age amount tax credit. This is something that you all, I think, if you're above age 65, that you should be. If you're not doing this, you need to start getting either a better accountant or use some kind of software, because it's cooked into the program. But that amount is $9,028 for 2025. If you're 65 years of age or older, on December 31st of the tax year, you can claim the age tax credit. Old age security recovery tax. This is about the threshold of you losing your old age security. Many of you who contact us and want retirement plans, you're worried about pay less tax, but also making sure you don't give back any of your old age security. It's one of the biggest reasons to get a retirement plan done. So what does this really mean? The taxable income up to $93,454, you won't have any old age security clawback in 2025. The moment you cross over that threshold, that's the threshold, right? $93,454, you lose 15 cents for every dollar that you're above $93,454. And if you go above $157,000, you've lost all of your old age security. And there are so many ways that we can help you avoid losing your old age security. So if you're interested in that, give us a call, send us an email, and we can start working on that for you. Okay, finally, let's talk about the tax rates. Just to give you some insight, tax rates have gone up in terms of not the rate, but the amount of money. So they've raised that. The first $57,000, the federal tax rate is 15%. It's very useful for you to know so that you can say, okay, well, how much money am I getting? Most seniors that I see are somewhere between $57,000 up to, let's say, the second tax bracket. Most people are in that. People who have big RSP accounts like $2 million, $3 million, you're in a seriously different tax bracket, and you hope that you're married so you can do some pension income splitting there. Well, that's it. I hope you enjoyed today's video. Thanks for sticking around. I really appreciated doing the first video of 2025. I look forward to doing many videos this year. And as always, put your comments below. I love reading your comments, and I look forward to seeing you in the next video. Thanks, and be well.